Okay, let's dive right into this. Welcome to today's Explainer, where we're investigating what I can really only describe as a fascinating financial mystery in the resource sector. We're looking squarely at AIC Mines. Now, on the surface, this looks like a straightforward story of a booming copper company. But as any focused learner of the markets knows, the headline is rarely the whole story. Today, we're going to use the data to deconstruct exactly what is happening inside this company. We're going to separate the noise from the numbers and figure out if this is a true structural transformation or just a really well-timed cyclical peak. Our investigation starts with a single, massive clue. 41.5 million Australian dollars. That is AIC Mines' reported net profit for the 2026 financial year. If you're an investor, a number like that immediately grabs your attention, right? It's the kind of figure that makes you sit up and take notice. But here's the thing. The absolute number isn't actually the most important part of the story. It's the sheer velocity behind it that makes things really interesting. Now, what's really interesting about these numbers is the massive mathematical disconnect. Just consider this comparison. Net profit absolutely exploded by roughly 177%, jumping from $15 million to $41.5 million. But over on the other side, revenue only increased by about 29%, going from $189.6 million up to $245.2 million. So how exactly does a company nearly triple its profit when its sales only go up by a third? Well, that is the central mystery we are unpacking today. Did AIC Mines fundamentally transform into a highly valuable, high-margin copper producer? Or are we just looking at a company temporarily surfing the peak of a very favorable copper price wave, right before their costs skyrocket? Section 1. Looking under the hood. To answer that central mystery, we've got to move past the financial headlines. After all, this isn't a software company selling recurring subscriptions, right? They literally dig rock out of the ground. And the physical reality for their FY26 actuals is pretty darn impressive. The beating heart of AIC Mines is the Eloise copper mine up in Queensland. In FY 2026, they produced 13,064 tons of copper and 6,621 ounces of gold in concentrate. But the absolutely crucial metric here is that they achieved their production guidance for the third consecutive year. If you follow the mining sector, you know that setting a production target is easy, but actually pulling that metal out of the ground exactly on schedule, that is incredibly difficult. Consistently hitting guidance is a very, very strong positive signal about management's operational competence. But producing the metal is really only half the battle. The other half is what it actually costs you to produce it. For FY 2026, AIC Mines reported an all-in sustaining cost, or AISC, of roughly $499 per pound of copper sold. This number is absolutely critical. Revenue just tells us how much copper went out the door, but this $499 figure, that represents the true ground-level economic cost of keeping the entire operation running and producing that copper. But here is where we hit the very first complication in our investigation. While the annual average was just under $5, the recent June quarter flashed a massive warning sign. The AISC suddenly spiked to $8.65 per pound. So why the sudden jump? Well, the company cited higher diesel prices, lower copper grades, and weaker sales timing. It's a stark reminder that mining economics are fragile and they can deteriorate rapidly. The annual numbers look great, for sure, but that recent quarter proves that maintaining those margins is a constant uphill battle. Section 2. The cash flow contradiction. So, the Eloise mine generated a very healthy $63.3 million in net mine cash flow. That is fantastic. But look at where every single dollar of that is actually going. They are pouring cash into developing the new Jericho mine, expanding the Eloise processing plant, funding extensive underground development, upgrading infrastructure, and paying for ongoing exploration. In FY26, capital investment at Eloise alone was about $57.2 million. They are consuming their strong cash flow to aggressively fund future expansion. They definitely aren't content just being a small, profitable producer. They're spending heavily to transform into something much, much bigger. Section 3. The growth gamble. And this growth plan brilliantly illustrates the sheer scale of what management is trying to pull off here. Just think about this production trajectory. We start with the FY26 actuals of roughly 13,000 tons. Next year, they're targeting a midpoint of 18,000 tons. And by FY29, they want to hit a midpoint of 26,000 tons. They are attempting to practically double their copper production in just a few short years. The upside here is staggering, sure, but the execution risk of scaling up a mining operation this fast is equally immense. Which makes this next data point almost unbelievable.
Despite forecasting this massive leap in production, AIC Mines is targeting an AISC of between A4080 and A520 per pound for FY 2027. They are aiming to significantly increase output without a dramatic increase in their unit costs. If they actually pull this off, the operating leverage will be phenomenal. More copper to sell at essentially the same cost to produce means profit margins could widen exponentially.
Section 4. The bull versus bear case. But operating leverage is a double-edged sword, isn't it? In our bull case scenario, copper prices stay strong, production hits that 18,000-ton mark, the new Jericho mine ramps up smoothly, and costs stay controlled. In this scenario, that $41.5 million profit we started with is literally just the beginning of a massive earnings run. But consider the bear case. If copper prices drop, diesel stays expensive, the expansion hits delays, and costs balloon above guidance, well, that exact same operating leverage works in reverse. Margins would be rapidly destroyed, and the company could suddenly find itself needing a massive injection of outside capital just to survive. Which leads us directly to the balance sheet, and a number that every single investor needs to watch like a hawk: $797.6 million. That is the current outstanding share count, and according to the market data in our source material, that count has increased by roughly 27.4% year over year. As we all know, growth in mining is very rarely free. So the crucial point to remember is this. Yes, basic earnings per share still managed to roughly double in FY 26 to $8.0527, which means the massive profit jump easily outpaced the new shares issued. That's great news. However, as the company enters its most aggressive phase of expansion, you absolutely must watch the balance sheet. If earnings double, but the share count quadruples to pay for the expansion, the actual value for the individual shareholder is heavily diluted.
Section 5. The final verdict.
Okay, we followed the clues from the headline profit down into the mine shafts, through the cash flows, and right into the expansion plans. Right now, current market data puts AIC Mines at roughly a $646 million valuation. That gives them a trailing price-to-earnings ratio of about 23.9, but a forward PE of just 10.6. So here's the ultimate question. Is the market already pricing in the absolute perfection of this expansion plan? If the company hits its targets, today's valuation might actually look incredibly cheap in hindsight. But if the production ramp-up disappoints, investors might quickly realize they overpaid for a growth story that just didn't materialize.
So if you're tracking this company over the next few quarters, block out the noise and focus exclusively on these three metrics. Number 1, copper production. Are they actually moving toward that 18,000-ton target? Number 2, AISC. Can they keep costs contained within that A480 to A520 range, or will inflation blow out their margins? And number 3, the most important of all, cash flow. Does higher production actually translate into free cash? Because at the end of the day, digging up rocks isn't the price. Generating cash is. Based on the documentary Architecture in our source, here is the final classification for AIC Mines. It is a watch or speculative buy for high-risk growth investors. Let me be totally clear about what this actually means. This is not a safe defensive play. There is no dividend yield here to protect your downside. You're giving up immediate cash returns in exchange for highly leveraged, high-risk bet on future copper prices and management's ability to execute a massive operational expansion flawlessly. We know the 1777% profit jump happened. That's a fact. But they're plunging all that cash right back into the ground to build the Jericho mine, setting the stage for what happens next. The next few quarterly reports are going to be absolutely critical to watch. To wrap up today's explainer, I've compiled this comprehensive investor checklist for AIC Mines. Feel free to pause and take a snapshot of this. It summarizes the whole shebang, from their stellar FY26 profit right down to their ambitious FY29 targets. But before you go, I want to leave you with this final thought. As they pour all this cash back into the dirt, is that massive profit jump just a snapshot of a cyclical peak? Or will management flawlessly execute their grand plan, proving that this is actually the very beginning of an entirely new, highly lucrative era? The next few quarterly reports will tell the tale.